Hi, everyone, and welcome to another edition of Table Talk with Mike. And today I thought I would talk about one of the most important things when you apply for any kind of financing with the lender. When you're a business owner, a small business, medium-sized business, even a large business, doesn't really matter what size you are, but your financial statements are a huge factor when it comes to whether or not you can be approved for a loan or not. And I wanted to kind of go over some of the different levels of financial statements that your lender may ask you for. So there are different ways to do it. As a sole proprietorship, where you have not incorporated a company, where you're just working on your own and you record everything on your personal taxes. Your lender is going to want to see your personal tax return, which will have a statement of business activities outlining essentially your revenues and expenses. And for a sole proprietorship, that's generally going to be good enough. Now, once you've incorporated your company, which is a whole other topic of discussion as to why there are benefits to doing so as a business owner, but in this particular case, we'll assume that you are already incorporated. So as an incorporated company, a limited company, the very first level of financial statements that your lender may ask you for would be either your corporate tax return, or what is very similar to that as far as a financial statement goes that your accountant would put together, would be a compilation statement or a notice to reader financial statement. So the financial statements will have a notice to reader financial statement, will have a balance sheet and an income statement, and that's generally all there is. Now, in this particular level of, this is like the bottom level of a complexity when it comes to financial statements. And you're typically, for a small business, even a medium-sized business, will likely be able to get away with a notice to reader financial statement or a compilation statement for the lender that you're working with. What this means is it's essentially your accountant is taking the information that you provided to them from, hopefully you have an internal bookkeeping program that you use, whether it be QuickBooks or something along those lines. Pass that information off to your accountant, and your accountant essentially takes all that information, all those figures, and put them into a balance sheet and an income statement that you can then provide to your lender. There isn't a lot of verification or confirmation that your accountant will do when compiling the numbers and putting the statements together. It's really just you provide the information, they put it together, and there you go. The next level above that has a little bit more complexity, a little bit more verification and confirmation required by your accountant, would be a review engagement statement. So in this particular case, the accountant is on the hook a little bit more. There is some responsibility that they have to provide. And in the event that it's ever deemed that there was fraud within the financial statements, because the accountant has taken more of a role in verifying some of the information on there, they can become liable as well. So for some lenders, depending on how large your company is or how much financing you're looking for, they may ask you for a review engagement statement simply because there's more detail that goes into it. There's more confirmation and verification completed by the accountant to ensure that the numbers are accurate and there is no fraud being put forth through the financial statements. So in this particular case, you'll have the balance sheet, you'll have the income statement. More than likely, you'll have a cash flow statement. You'll also have notes to the financials that go into detail explaining some of the figures that are found in the balance sheet or the income statement or the cash flow statement. And so there's more detail that goes into a review engagement statement. Now, as you move up in complexity with these statements, obviously the cost goes up to you as working with your accountant. They're going to charge you more. But you can be rest assured that the numbers in those financial statements are going to be stronger the more detailed and higher up the process we go with these financial statements. The next step beyond review engagement would be an audited financial statement, which, just as it sounds, is very detail-oriented, very in-depth requirements from the accountant as far as verifying information, confirming figures, going through it with a fine-tooth comb, and they're essentially signing off that yes, everything is above board and all these numbers are accurate. And again, as I mentioned earlier, the greater the complexity, the greater the responsibility is put onto the accountant's shoulders as far as how that looks if in the event any potential accusations of fraud come forward. So in the case where an accountant has been complicit with potentially some fraud in the financial statements, and it's proven in court, well, the accountant can lose their ability to operate as an accountant, to lose their license, more or less. So again, those are the basics. I'm not going to go into great detail on all of the things that go into those statements, but those are the three main levels of statements that you're going to be required to ask for, or your lender will ask you for. Again, you're not typically going to see anything beyond a review engagement statement for small or medium-sized business. And anyone who's watching this video is probably not going to be, in a multinational corporation, knowing full well that they're going to have audited financial statements. The bigger they get, the more important that becomes. So hopefully that helps. If you have any questions, certainly leave a message below or send me a direct message, and I will be happy to answer any of those that you may have. Thanks again. We'll see you soon.